Cool. So over the next half an hour or so, I'm hopefully going to give you an idea of what we're flagging as really important themes within infrastructure, both this year going forwards, but also kind of how we see the industry going to be developing from a building materials perspective, from technology, and importantly, which markets are going to be key for anyone involved in the infrastructure sector, anyone involved in power, anyone involved in renewables over the next 10 years or so. So both short-term and long-term themes we're going to be looking at. If we start kind of with our immediate future, so what's the outlook like for 2019? Well, each year Fitch publishes a number of key themes in each of the sectors that we look at. And in infrastructure this year, we have two themes which look at the levels of investment going into infrastructure, and two themes where we're looking at particular sectors. So those two sectors are transmission and distribution, so grid infrastructure in the power sector, and water desalination and water treatment infrastructure in the utility space. So in terms of the level of investment, it's actually a bit of a mixed picture. We've got a lot of political risk out there at the moment, and political risk and infrastructure are two themes that are very closely linked. That's always been the case, and it will continue to be the case. However, if you look at what's going on in the world, never has those two topics of politics and infrastructure decisions on big investments, big projects, been so heavily intertwined. You have to look at Brexit and how that's really dominating political discourse in Europe and pushing big things like cross-border projects, investment in the UK sector, for example, pushing those decisions down the line, meaning there's a potential that a lot of projects are going to be delayed. If you look at the US, you've got obviously Mr. Trump focusing his attentions on things like border security or trade. And again, his big infrastructure plan, he said he wanted to invest $1 trillion in infrastructure. It's just not materializing. It's the same around the world. In Latin America, you've got AMLO in Mexico, you've got new governments in Asia as well, all intertwining politics and infrastructure. So really a danger of political risk leading to lower levels of investment in infrastructure going forwards. In another area of investment, we're looking at oil prices. So at Fitch Solutions, we forecast Brent to average $75 a barrel in 2019 and $82 a barrel in 2020. That's an improvement on where we were last year, but it's still not the kind of increase in oil prices that we need to see for a massive boom in investment in those markets where oil prices really are the determinant of how much money is invested. So we're looking at markets like the GCC, Saudi Arabia, Kuwait. We're looking at the likes of Nigeria. We're looking at the likes of the Latin American oil producers who aren't going to see that big windfall of oil money that we saw before the crash in 2014. And in terms of the two sectors that we're highlighting, so transmission infrastructure, there's been a lot of focus in recent years on boosting generation capacity in emerging markets. So Power Africa, getting generation assets built in emerging markets to supply that thirst for electricity. That's been great. However, the problem has arisen where too many assets are idle. They're not connected to the grid in time and people lose money. And so we think there's going to be more of a shift towards investment in transmission infrastructure rather than generation. Also, obviously, the growth of renewables in developed markets is a major source, or is going to be a major driver of investment into transmission infrastructure. If you think of how decentralized our power networks is becoming, that's going to require significant investment in grid infrastructure. And finally, on water infrastructure, this is very much an emerging market trend driven by urbanization. We all know people moving to cities demand more infrastructure. And we expect around 4.4 billion more people to be living in cities by 2050 than currently do. So that's a hell of a lot of more infrastructure needed. And as people move to cities, they demand more water-intensive products, be it food, be it fashion, be it industry, all require more water or create more wastewater. And therefore, we think the story of water infrastructure in emerging markets is going to be very, very strong going forwards. So that's what we're flagging in 2019. However, I want to talk a bit about how we see the industry changing going forwards. Those of you in infrastructure and construction know it's been quite a slow industry to develop compared to things like autos, to ICT, still building in bricks and mortar, things like that. We are still by no means going to see a sudden change in the industry, but we are at a point now where technology and improvements in technology are allowing for new ways to develop projects being utilized. There's lots of talks about smart cities, and I don't really want to get into that because it's not really something we think is a as a useful way to look at this industry. However, we are flagging the technologies that you can see on the screen here as being areas where we can actually see a realistic implementation of that relatively soon. So if we just quickly go around, I think building materials is the most important one within all of these technologies. I'll come on to a bit more detail about this later, but essentially investment into lowering the carbon footprint of building materials is going to be pretty paramount going forwards. More clients will demand energy efficient projects, and there'll be more legislation put in place to lower the carbon intensity of producing things like cement. So innovation in building materials will be really important. 3D printing gets banded around quite a lot as a new technology that could revolutionize the sector. We don't really think it's got kind of mass application. It's expensive, it's unproven, but we can definitely see 5–10 years' time it having an application where you can see it on certain projects in the infrastructure space, complex projects where it requires on-site manufacturing and things like that. Again, robotics, the industry suffers from a problem of a manpower problem. We have, in many markets, too much labor, in other markets, not enough labor, and robotics kind of can step into that to reduce things like wastage on projects. But importantly, it's modular construction I really want to talk about. Modular construction, i.e. mass-producing off-site, bringing on-site, really speaks to the problems of the industry in that it lowers costs for companies, it increases efficiency in terms of project delivery and wastage, and really you can build in the environmental considerations that are now really important with regards to client demands. Off-site, it's much easier to do it in a factory than it is actually on-site. So modular construction is something that we think has real near-term application. Finally, just looking at smart sensors and dynamic pricing. So efficient utilization of existing infrastructure is a really important thing going forwards. We see a lot of governments, particularly in Western Europe, saying we're not going to invest as much as we used to in our hard infrastructure. Not as many roads, not as many new railways. What they're going to do instead is invest in the technologies which can get more out of existing assets. And to make sure that happens, they need to understand exactly how those assets are being used, how they're wearing, how they're breaking. And to do that, they need to use technologies like smart sensors. So if you look at, in the States, a number of highways operated by the company Ferrovial, they now utilize smart sensors, so they know when traffic's going to be high, when traffic's going to be low, how to affect pricing on that toll road, and importantly, where the wear and tear of that project is going to be. So they can be preemptive in their maintenance and reduce costs and reduce disruption, and ultimately boost revenues. So smart sensors, again, really important going forwards. Just coming back to the idea of building materials then, and it really is kind of at the central part of the entire change of the industry we think is going to happen. The chart on the right-hand side, the pie chart, just really shows why this is going to be a thing. Of all the carbon emissions that come from a building, 15% of its entire lifetime of carbon emissions comes from the materials used in its construction. Considering construction can account for as little as 5% or less of an entire asset's lifetime, the fact that it accounts for such a large amount of carbon emissions is a real issue. And at a time where everyone is increasingly legislating to reduce carbon emissions of certain industries, we expect the cement sector, in particular, to be facing increasingly punitive measures to reduce the carbon that they emit whilst producing building materials. Now, the sector itself has already started to do this. You've seen majors like Lafarge, CRH, Heidelberg, Italy Cement, all now starting to produce lower carbon cement using things like blended products or compound materials by integrating plastics or recycled materials into the process of making cement, all of which start to lower the carbon footprint of cement. Now, this is kind of a half step that's being made. We don't think that suddenly the entire cement industry is going to change. The demand from clients for more carbon efficient projects is still probably limited to Europe. Even in the States, they're not really that bothered about the carbon efficiency of projects. And obviously, Asia really aren't there yet. China turns out so much cement that they don't know what to do with it. And if you look at the chart on the right, on the left, you can see that we're forecasting that the construction industry on a global level will be $3 trillion larger in terms of output over the next 10 years. The majority of that value is going to be created in emerging markets where carbon footprints aren't really a cause for concern. We're readily admitting that this isn't going to be a massive thing right now. However, if you look at how Northwestern Europe in particular has been starting to tender projects and how clients are demanding new projects, particularly in the real estate sector, the carbon efficiency of buildings is going to be of paramount importance. And we expect this to be a trend that will start to roll out globally, particularly given COP21 and how that was a global signing up of most countries, including China. And so this will be increasingly on the agenda with regards to building materials. So moving away from themes and starting to look at some projects, some sectors, and some markets. At Fitch Solutions, we've got a global database of key projects in infrastructure around the world. There's about nearly $10 trillion worth of projects logged in our database. And you can see how that value is split here. So we can go region by region and sector by sector. If you see around the globe, $3.6 trillion of that $10 trillion figure is located within Asia. A lot of that is within China, and a lot of that is within India. But an increasing amount comes from Southeast Asia. So the growing markets of Malaysia, Indonesia, Vietnam, Philippines, all rapidly growing markets with a hell of a lot of money being invested in infrastructure. Outside of Asia, Middle East and North Africa, $1.6 trillion. Obviously, it's smaller than Asia. However, on a per capita basis, that's actually one of the most impressive investment profiles globally. So the Middle East and North Africa, despite lower oil prices, still has a lot of infrastructure projects that are ongoing and in planning. Sub-Saharan Africa is the noticeable underperformer. Obviously, nearly 1 billion people live there, but only $680 billion worth of projects we have currently logged. Still a long way to go to get infrastructure projects really going there. A lot of governments still fail to get any projects built, and obviously China has a massive role to play in getting those projects built, leaving not a lot of space for everyone else. Latin America, one of the more interesting markets to look at, I think, because it has succeeded in attracting private financing into its infrastructure sector, which a lot of other emerging regions have failed to do. They have a lot of innovative financing models in the public-private partnership space, and there's a lot of money available for them. So markets like Colombia and Peru really stand out. Mexico as well had done until the recent election led to President AMLO essentially going after a lot of these public-private partnership projects and cancelling them, just showing how politics can really interfere with infrastructure. But Latin America is an interesting market nonetheless. And finally, in North America and Western Europe, we have a very mature infrastructure market here, but still we have multiple billion-dollar projects that are in planning still. High-speed rail in Europe is really a market to watch. And renewables growth in both North America and Western Europe will be a very strong story going forward still, and I'll come on to more of that in a moment. Just picking out two sectors globally, it is the rail sector and it is renewables, which really are the two strongest performing in terms of new projects coming to market. If you look at the top chart there, you can see the number of projects we're seeing in the rail segment really growing. This speaks to efforts to deal with urbanization, so more and more projects to develop metros and link major cities to surrounding cities to increase commuters. And high-speed rail, a lot of high-speed rail projects we see as kind of vanity projects, which aren't necessarily good investments. However, it's undoubtable now that if you look at Europe, if you look at Asia and Latin America, high-speed rail is very much on the agenda for these three markets. There are a lot of projects in North America which we don't think will gain much traction, given the competitive nature of low-cost airlines. But in general, high-speed rail in Europe and Asia is a very strong story. If we focus in on the power sector, I think this chart here shows very much what the story is. This shows our forecasts for power generation growth in each region. And as you can see, Asia is going to add more generation capacity than pretty much the rest of the world combined over the next 10 years. That is a tremendous amount of growth. That is a tremendous amount of opportunity. And importantly, there is opportunity across all sectors within Asia. The colors you can see are the breakdowns of various fuel types. And as you can see, whereas a lot of parts of the world are switching off their coal-fired power stations, there's still a tremendous amount of growth in Asian coal-fired power. At the same time, renewables, Asia will add pretty much the same amount of renewables as the rest of the world combined over the next decade. So be it dirty fuel, be it clean fuel, Asia is very much the center of the global power sector at the moment. If we move aside from Asia, though, we can see some other regions are more focused on particular fuel types. So if we look at Western Europe and North America, the strongest growth there is going to be in renewables and natural gas. Again, this very much speaks to efforts to reduce carbon emissions and the falling cost of renewables as the auction system, rather than feed-in tariffs, takes over. In particular, we would highlight markets such as Germany, which will continue to experience very strong growth in renewables, the UK offshore markets, and Spain and Italy are the two Western European markets to watch with regards to positive outlooks in renewables. Spain had a really problematic few years with regards to its renewables sectors as the government retroactively changed its feed-in tariffs. However, they had new auctions, they were very, very popular, and they're planning much more. So Spain is really the market to watch. And Italy, again, more politically volatile there, so we don't know whether their plans to tender more renewables projects there will go ahead as much as we do in Spain. But still, Western European renewables is a good sector to be in. Outside of Western Europe and North America, Middle East and North Africa, very focused on natural gas, and that is as governments around the region want to stop burning their crude oil in power, and they want to start exporting it more. And to do that, they are trying to capitalize on their gas reserves rather than using their domestic crude supplies. And so there's a lot of investment going into gas-fired power stations in the Middle East. In sub-Saharan Africa, despite all the efforts to try and electrify the continent, we're still seeing that being the slowest growth region globally. And a lot of the emphasis there is still going to be on hydropower. Hydropower is great in some cases in sub-Saharan Africa because it's cheap, it's clean. However, lots of big projects, lots of projects get very delayed due to environmental protests. And obviously, drought can basically cripple your economy. And we saw that over the last few years, particularly in southern Africa. So an over-reliance on hydropower, perhaps, in sub-Saharan Africa. Coming back to Europe and looking back at the transport sector and social infrastructure, this is data from our key projects database, looking at projects purely at planning. So projects that are yet to come to market, these are potential opportunities to look at. Again, you can see the red in these columns represents the value in US dollar billions for the rail sector. The rail sector really is, across Europe, an area of focus, and that's largely because of the role that the European Union has in driving projects forward. The EU, under its multi-annual financial frameworks, distributes money through the Connecting Europe facility and aims to invest in their strategic corridors called the 10T corridors. And a lot of that has the goal of linking up Europe's rail networks. So again, I know I keep talking about carbon and green, but it really is a theme within European infrastructure driven by the European Union. So a lot of the projects that they are supporting are efforts to decrease carbon emissions. And in the rail sector, that's really shifting freight from road onto rail. So increasing the amount of freight, taking lorries off the road basically and putting them onto railways. Not only does it free up room on the roads, so there needs to be less investment in roads, but it also, obviously, if you can take 100 lorries off the road, that's good in terms of your carbon footprint. There are also quite a lot of multimodal projects going forwards. And by multimodal, I mean connecting ports to the rail networks, connecting airports to the rail networks to allow that efficient transport of containers and goods. And finally, again, the EU will continue to support public transport in cities across the continent. There are very, very few major cities where the European Union hasn't supported some kind of light rail or metro system. In fact, for the majority of Central and Eastern Europe, the EU has 100% presence in all of their light rail and metro projects. So if you see the EU backing a project, that's a good project to be involved in. Just looking at some key projects in some markets to be focusing on. These are kind of the headline-grabbing ones. But when looking at these projects, just bear in mind what I was talking about earlier in terms of political risk and how the big headline-grabbing projects can be ones which really cause a lot of problems for governments as opposition parties trying to boost their support by opposing these big, expensive, high-profile projects. In Germany and Denmark, we're finally moving the Fehmarnbelt Tunnel project forward, which is around 7 to 8 billion euros worth of investment, which will link Germany and Denmark through an underwater tunnel. This is an example of how two countries trying to link transport networks can be more complex than we initially think. It's been heavily delayed as both sides are trying to agree on who's responsible to what, who's financing what, and when should we build it. But that is now moving forwards, and so expect that to come to market pretty soon in terms of tendering. In Spain and France, there's a lot of focus on the high-speed rail networks that I was talking about earlier. Spanish politics generally has thrown a spanner in the works with regards to realizing some of its high-speed rail network with a very high price tag and not necessarily a strong economic case. However, for these two particular projects, because they are part of the EU strategic network, the EU will continue to push them forward, and we think the Spanish government will get behind them. In France, the Grand Paris Express is now the largest infrastructure project in Europe. It's only just started its very initial phase, and it's going to continue up to 2032 if all goes to plan. And so there's still a lot more to come with that project as Paris tries to increase its metro network. And finally, just quickly, East Rail Link in Sweden. It's not a particularly exciting project, but because it's in Sweden, Sweden often tops our risk indexes at Fitch with regards to project implementation. So if they say a project's going to go ahead, it generally goes ahead relatively on time and relatively on budget. So it's worth flagging, even though it's not a particularly exciting project. On the flip side, we have Rail Baltica, which is, as the name suggests, a high-speed line that will link the Baltic states to the rest of Europe. Again, many different stakeholders, many different government agendas, many different spending priorities, which has delayed this project. And I think they've just announced an additional 2-year delay to it. However, it's kind of the ultimate showpiece project for the European Union in that it's linking former Soviet bloc countries to the rest of Europe via a high-speed line. The EU will continue to support it and try and get everyone around the table to see this project move forward. So in Europe, the EU will continue to back rail is kind of the big story here. However, exporting outside of Europe, this really is depending on what you're interested in terms of your company, you can have a lot of different answers to this question of where should we be looking. But as you saw on the projects chart, Asia really is the focus of a lot of infrastructure growth globally. This chart here essentially helps you to split out the different types of markets within Asia. So in the top left-hand corner, we have what we call our high-risk, high-reward markets. They are frontier, very small. However, they're growing extremely fast. In excess of 15–20% annually new value is created in these construction sectors. If you move down the chart, you start to move to your traditional fast-growing Southeast Asian markets where we have billion-dollar investment programs, a growing size of these industries, meaning there is actually kind of a long-term growth story here. And also they are more open to international firms, whereas those frontier markets are heavily dominated by the likes of China. Whereas markets like Vietnam, the Philippines, Sri Lanka, Thailand, and Malaysia, they're all quite open to international competition. And finally, we have our more developed markets. Again, they are much slower growth, as you can see. So our forecast for construction growth is on the side here. Those developed markets averaging around 2 to 4% annual real growth, whereas the emerging markets at the top, 10, 12 over the next 5 years. Saying that, even within developed markets in Asia, there is probably a lot more going on than you might see elsewhere, particularly in Australia and New Zealand, where big infrastructure programs are now underway, and they're spending billions on projects. If we focus in on some kind of key emerging markets, though, it's really the Mekong region, which is kind of the one that we're flagging, because we think there are a number of factors driving growth in these markets, rather than it being all down to one story. Essentially, a number of these markets, particularly Cambodia, Vietnam, and Myanmar, stand to benefit from Chinese companies looking to relocate to lower cost manufacturing bases. In the same way that China boomed because a lot of firms moved their businesses to China because of low wages, wages have risen dramatically in China now, and firms are struggling, and they're looking to relocate, and the Chinese government's willing to help them relocate, and they are now looking at Southeast Asia as the next kind of manufacturing hub. The problem being that the infrastructure in these markets is not supportive of exporters. And so what they're looking to do is develop significant rail and road networks and also develop their power infrastructure in order to facilitate this growth in the manufacturing sector that's driven by China. So if you look to the likes of Cambodia, Laos, and Thailand in particular, they are strategically placed on China's Belt and Road Initiative. This is kind of a very big theme in infrastructure, and we often get asked, how do non-Chinese companies benefit from Belt and Road? The answer is, it's quite hard to directly benefit. However, there's a tremendous amount of opportunity that stems from the growth that the Chinese are developing in these markets. So things like, once the Chinese develop their core rail network, developing links to that rail network from secondary cities and second-tier cities in these markets is really, really important. And the government will really try to do this, as currently governments in Asia get a lot of problems from saying China is just building this railway to benefit itself. There's no benefit for the people that live in these countries. So the government's looking to use the Chinese network to then develop much larger infrastructure projects. If we move to the Middle East, we really, when I talk about the Middle East, we're talking about the Gulf Cooperation Council countries in North Africa, the likes of Iran, Iraq. However, it's really the GCC where we highlight the best markets to be in. That's because they're much lower risk than their North African counterparts, and they have a lot more money to spend on infrastructure. That said, these markets have obviously suffered from the fall in oil prices in recent times. But as a result of that, they're now embarking on quite significant economic diversification programs, which is a very good thing for infrastructure. Traditionally, oil windfalls, invest in big, high-profile projects, high-speed rail lines in Saudi Arabia, for example. These are kind of one-off projects, whereas the economic diversification that's happening in these markets is really now driving a diversification of demand for infrastructure, which is good for long-term growth. We have scored the markets within the GCC on their ability to diversify their economies and how well they're going to be able to do this. As you can see, the UAE and Saudi Arabia really stand out as markets that actually have a good chance of diversifying their economies away from over-reliance on oil. Saudi Arabia has kind of taken a small kind of backward step with regards to that. Essentially, with the politics in Saudi Arabia, they took the foot off the gas a little bit with things like IPOing Saudi Aramco and opening up other sectors for private investment. However, we still think that Saudi Arabia, given its scale and given the Vision 2030 that the government continues to pursue, has got a lot of potential for infrastructure. The other smaller GCC markets, the likes of Oman, Kuwait, Bahrain, these markets will struggle. There is a good short-term growth story here over the next decade or so. However, just because they are much, much smaller and have much less demand factors for further infrastructure, we don't think there's a very good long-term growth story, so beyond the next 10 years. So if we just focus in very quickly on the key opportunities within Saudi Arabia, you can see from this chart here that they have a pipeline of projects. So these values are millions of US dollars, broken up by stage and what sectors. And you can see there's a lot of opportunity within across all sectors. And importantly, construction. When you see construction there, that's things like industrial projects. Saudi Arabia is really trying to move up the value chain within its oil sector, so developing things like refineries and petrochemical plants in order to make more of its domestic resources rather than just exporting crude. It's going to be a slow process, but certainly they have the financial firepower to see these projects realized. They're very ambitious, but we're starting to see people very much interested in the potential for the Saudi petrochemicals sector to grow exponentially. Also, a lot being invested in things like transport. Transport, there's a lot of roads in Saudi Arabia, but not a lot else. So they're really focusing on developing their ports and rail links to those ports. You hear a lot about the Gulf Cooperation rail network, which will link all the GCC markets via rail. That project probably won't ever happen because there's not really a good business case for it. However, there is a good business case for rail network within Saudi Arabia because of multiple cities with multi-million population, whereas you don't really get that in Doha, or you don't really get it in the UAE. So rail in Saudi Arabia, again, a good long-term bet. Very quickly looking at the UAE. The UAE is probably our favorite market within this, and it's purely because of that diversification which has already happened there. It's an economy which has a strong financial sector. Tourism is obviously a boom industry, and it's got a very good hub status already. So there's lots of investment coming from all over the world. Expo 2020 will be a kind of a catalyst for growth over the next few years, and we are forecasting, as you can see from this chart here, for growth to slow. However, whereas growth slowing in other markets would be a problem, because of the diverse array of different project drivers within Saudi Arabia, within the UAE, you can see that growth starts to tick up again if you look at the red line. So the longer-term growth outlook for the UAE is very, very positive. Final slide. I know we've covered a lot already. Just wanted to look at some key sub-Saharan African markets. As I mentioned earlier, sub-Saharan Africa is quite a difficult place to develop infrastructure. However, there's a lot of effort now going into supporting governments getting these key infrastructure markets going. This is providing kind of project preparation assistance, people like the World Bank and the IFC providing insurance for investors, and helping the likes of the African Development Bank get these projects financed. So when looking at all the projects in sub-Saharan Africa, you need to think of the rewards on offer and the risks. This chart here shows one of our indexes, which looks at risks and rewards, with risks up the axis here and rewards along the bottom. And the higher the score, the more attractive the market. So really where you want to be is in that top right-hand corner. Obviously, we have the likes of South Africa there. It's a slow-growing market, and there's a lot of problems there, but given it's a developed market, basically in comparison to the rest of the continent, it still wins. It still performs very well. But also there we have Ghana, we have Rwanda, and we have Kenya. These three markets are growing very fast. They have an impressive risk profile relative to other peers. And importantly, they have succeeded in attracting private finance into their infrastructure sector. Governments in sub-Saharan Africa are never going to have enough money to finance all their projects themselves. And they're very, very cautious about being over-reliant on China to finance their projects. We've seen this become an issue. The so-called debt trap, where so many loans have been extended by China that governments have to face growing criticism that they're kind of selling off their sovereignty. These three markets have succeeded in getting private finance and therefore don't have to be reliant on China. In the bottom right-hand corner, these are what we would call our high reward, high risk markets. So these are the ones similar to the likes of Myanmar and those frontier markets in Asia, where there's a lot going on. These are big markets, they're fast growing, there's a lot of projects in the pipeline, but also risks are very high, particularly things like political risk, but also just general project implementation, years of delays. Land acquisition is a real problem because no one really knows who owns what land. And also just operational risk, getting your people there, ensuring that you have the proper legal frameworks in place. Bureaucratic problems are incredibly burdensome in sub-Saharan African infrastructure. It can take years just to get permit approvals. And so these markets are really where you're going to struggle to implement those projects, even though they are there. I've talked about a lot there. I'm not sure how long I've gone on, but that kind of brings me to the end of what I was hoping to get across. Look forward to your questions.